wherever you are on the planet. Thank you ever so much to Michelle and Jackson for an illuminating discussion on law enforcement and protecting against financial crime. So today's panel I will be moderating balancing privacy and risks and financial integrity in the crypto space. As we see the rates of adoption increase in crypto, not only in monetary terms, but also in quality human capital move into the space, and more to the point of today's panel, the regulator lens is clearly now pointing towards the industry. Is this a surprise to anyone? Did we see this coming? Well, let's dig into the specifics of what the policymaker focus actually is and what, if anything, the community should do. So before we get onto the main topics of today's debate, let me introduce our panel, of which I'm sure you will agree is full of folks with a terrific pedigree that will better help us understand the issues faced by the industry and what can be done to address them. So firstly, let's go to Katherine Hu of TRM Labs. Could you please introduce yourself and what your background is and what your current role is, please?
Hi, yes, thanks, Ian. So I am a senior financial intelligence investigator at TRM Labs, which is a blockchain analytics company that helps organizations detect and investigate financial crime in digital assets. Prior to joining TRM Labs, I spent 5 years at the FBI, in part tracking cryptocurrency for federal prosecution. And prior to that, I was at PricewaterhouseCoopers doing forensic services for civil investigations. So, I'm happy to be here today to talk kind of about different experiences, civil and criminal, and all the considerations that come with that.
Thank you. And let me ask the same question to Mandeep next.
Thanks, Ian. Hey, everyone. Nice to be on the panel here talking to you. I'm the Chief Compliance and Risk Officer for Circle, which is a payments and transaction services infrastructure company, also the issuer of the USDC coin. Before coming to Circle, I was part of the Libra DM stablecoin project as well, and overall about 20 years of experience in the financial services fintech industry. Thank you.
Thank you. Next question, let's introduce Mriganka, please.
Hi, everyone. I'm Mriganka, one of the co-founders and the CEO of Merkle Science. So we also do blockchain analytics and forensics. One of the things that sets us apart from some of the others is the fact that we look at behavioral analytics that go beyond just blacklists of addresses to try and create a more predictive system. In terms of my background, I've started my career in investment banking, but very quickly moved over to cryptocurrency companies. Just before Merkle, I used to work at Luno, a crypto exchange across Africa, Southeast Asia, and Europe. So I think one of the key issues there we used to have was regulatory ambiguity, as well as the amount of crypto crime we faced. So looking forward to the panel where we talk about the complete change in the state of regulations and now versus like 2 or 3 years before.
Thank you. And our fourth panelist, Dave Jevans.
Thank you, Ian. Dave Jevans, I am the CEO and co-founder of Ciphertrace. We are a 6-year-old blockchain analytics company. We provide anti-money laundering controls for the biggest exchanges in the world, for a lot of the banks, especially as they're beginning to explore their journey in providing cryptocurrency services and banking services for crypto companies. And also law enforcement. I've been privileged to be able to work with the Financial Action Task Force for the last 2 years on a lot of the work that's been happening there and with our fantastic colleagues on that project, but also with governments around the world, the Department of Treasury in the United States, particularly FinCEN, but also DOJ, SEC, and a number of other regulators, MAS, FCA around the world.
Okay, well, thank you for the intros. Let's get into the debate with the first question that I'll pose to Katherine initially, and if anybody wants to follow up, and I'll remind the audience, if they have any questions, please do so, put them in the chat and we'll pick them up as we go through. Okay, so Katherine, following from the excellent fireside chat with Michelle, Let's start discussing where the US is right now in terms of the potential of bringing non-hosted wallets into the purview of regulators, in terms of authorities collecting specific transactional data. Perhaps firstly, if you could set the scene in the US in terms of FinCEN's recent announcements, what data would like to be captured, why and what does the industry think about this in terms of such issues as balancing privacy and protecting against economic crime, for example?
Thanks, Ian. First, I want to say thank you for having me. Like Michelle, this is my first foray into kind of the general public eye in the last 10 years of my career. Since having recently joined TRM Labs, I decided, not only to join them because understanding risk is important, but because I've also seen the importance of balancing our theme for today's talk through my work, risk and regulations versus what is, a very intrinsic human value, that of privacy. Let's just do some level setting. So FinCEN is really proposing a couple things here. And like everything else in crypto, the technology and the regulations are constantly evolving. We've sped along since Bitcoin came about. Regulators like FinCEN are essentially trying to regulate in real time. They're adapting older laws to today's time. Unhosted or self-hosted wallets are kind of a great example of this. Where FinCEN is proposing kind of updating the travel rule, which mandates that an MSB or money services business or VASP in crypto have know your customer KYC on not just their customers, but the counterparties as well. So this not only involves, positively identifying unhosted wallets, but also filling out a report, much like a currency transaction report or CTR, with transaction details, name, physical address, and identity verification for funds flowing to a counterparty greater than 10,000 or cumulatively greater than 10,000 within 24 hours. It also involves, MSBs and banks keeping transaction records and customer and counterparty information for transactions with unhosted wallets greater than $3,000. FinCEN must rely on kind of the existing Bank Secrecy Act of 1970 and kind of subsequent anti-money laundering laws to essentially collect, these data points to help them understand, who or what is behind a transaction. Because, this feeds into their broader sphere of detecting and preventing money laundering, which is their very mission. And I think the reasons, these issues are very interesting today is that they get into the very heart of crypto, the same qualities that really allow crypto to be, revolutionary. It's permissionless, programmable, decentralized, and fast and cross-border. But it also makes it very attractive to illicit actors who want to move the funds at the speed of the internet and kind of shield themselves in this perceived anonymity. And so we kind of have to, thread the needle a little bit here in fostering, responsible innovation and competitiveness, but also, making sure law enforcement has, every tool to stop illicit actors who want to use crypto to obfuscate what they're doing. And, I know this pretty well from my 5 years at the FBI. I looked at darknets and darknet vendors of opioids coming off the opioid crisis, mixers and tumblers, nation-state actors purchasing cyber power to conduct attacks, as I saw and indicted at the special counsel's office, and just your good old, frauds, pump and dump scams and romance scams. And, I spent so many late hours just kind of chasing the money around in crypto land and, daytime hours talking to companies, just hunting down the data. And frankly, there was no way we could have made a lot of these cases without the customer and counterparty information, as FinCEN is pushing to be collected and retained. And, without tools, like tools where I am now, that I've seen, help in these regards. I think it's really important to understand, this kind of background of needing certain data points in order for us to catch illicit activity. But I've also seen, as someone who has spent a summer as a bank teller, which you may or may not believe, but like I would have to fill out the BSA reports, and you do worry about you scaring away your customers, and how do you responsibly collect customer information? I really think about this kind of in my day-to-day. How do we meet these regulations, or maybe leverage some technology to help us collect this information responsibly or keep track of everything? Somewhere in the middle of all this, I think there is a balance. So I wanted to kind of level set about what is FinCEN really proposing here, and then kind of what is the data collection, and what should we really consider? Like, we're going to have to ask our customers for information, and to what extent that plays, or to what extent we can leverage technology to help us in that regard, I think will be really interesting. So I'll hand it back to you, Ian.
Well, thank you ever so much, Katherine. We wish you all the best success in your new career, and you bring a great wealth of knowledge to the industry, which is much needed. So thank you for that eloquent answer. And just from my side, on the other side of the pond in the UK, when we saw the FinCEN announcement at the end of last year, with just a short window for the industry to reply, we were somewhat shocked as a community as to the thinking there. But I was glad to hear from the earlier discussion, Michelle, with regards to FinCEN and other agencies wishing to engage further with the private sector, because that's how we get the right solution. That's how we get the right guardrails, and what sort of guardrails do we want? Fixed, solid, or some sort of flexibility around there, not to damage the development and the technology. So before we move to the next question, which will dive into all things FATF, does anybody else want to add anything regarding the approach to self-hosted wallets? Alrighty, we don't have any questions specifically related to it. I'll pick them up in a moment. Thank you for that. So next question, let's turn to Dave and his wonderful experience at Ciphertrace. So moving the discussion along to a more global focus. We appreciate that crypto does not care about borders and is global by design. As Michelle touched on earlier, the FATF Financial Action Task Force started looking at virtual assets and their associated service providers, or virtual asset service providers, VASPs, as a potential risk to money laundering and terrorist financing back in 2019. In the 2 years subsequent, could you perhaps give us an update on where we are today, focusing on recent updated guidance of the definition of a VASP, and perhaps touch on the recent 12-month review and what your personal view is to what to expect from the postponed updated guidance coming out later this year?
Well, thank you, Ian. It's been a very interesting 24 months. I would say that we've had a very good global response. There's a number of countries that are, I would say, leading the charge. United States is certainly one of them, but Japan has been very involved. But there's been about 70 countries involved quite closely with the FATF on development of the guidance. When we see the review, I think it takes a very thoughtful look at transaction patterns. So a number of companies, such as Ciphertrace, were consulted by FATF to provide guidance around how much, what is the volume and the number of transactions on hosted wallets versus unhosted wallets across different blockchains and different virtual currencies. How much percentage do we see across more anonymity preserving currencies? So I'm very pleased to see data entering the discussion at the regulators, both at FinCEN and at the more consultative groups like FATF. So it's nice to see decisions being made based on data. So I think that's a very positive trend. I'd say that some of the things that we're expecting is a little bit more definition around DeFi, and that's probably going to be the conversation moving forward, which certainly is linked to the unhosted wallet conversation. I'd say on the DeFi side of things, things are moving very, very, very quickly. So I would expect that we will see more discussion with FATF and other regulators, them and regulators themselves in this area. I would bring to mind the recent decision by Shapeshift which is a kind of an infamous or famous, if you will, currency swapping service that initially had no KYC compliance. Then in 2018 realized that they had to face up to regulatory controls, and so they had KYC, they had AML, and then has recently made the decision to become a DAO and dissolve the company and turn it over to basically anyone who owns tokens and have a decentralized model, which means that there's no one to go after, there's no one to regulate, and therefore they have no regulatory controls or responsibilities at all. I think this is the fundamental problem we're going to face over the next 3 to 4 to 5 years, and this is accelerating at an extremely high rate of speed as far as I can tell.
Well, thank you for that, Dave. And yeah, interestingly, you mentioned Shapeshift, and they're trying to perhaps turn away from KYC because it obviously is a business model question, and it asks to the point that it's an interesting strategy, because we can dive into this at the end when we talk about where we see the future, but how much regulation will be forced upon the decentralized finance space and what that looks like. Yeah, let's open it up to the panel. Anyone want to add anything in their experience regarding financial action task force, and perhaps what's the industry doing to sort of build out some solutions here?
Yeah, I guess I'd love to answer that. So I think the FATF guidelines, they've progressively gotten more detailed and have started tackling more and more segments of the cryptocurrency space. I think it started with just them defining VASPs back in 2018, and the recent guidance, the draft guidance now covers DeFi, some types of NFTs, so it does go very broad. I think as Dave mentioned, this does have far-reaching consequences for the industry. There would be probably 4 major things that I see happening on a broader level. So one is that it leads to the industry growing up much faster than it would have otherwise, because now everybody around the world needs to regulate cryptocurrencies. So institutionalization was earlier happening in markets, in certain markets, right? Like maybe the US, the UK, Singapore, but now this would be a push for institutionalization world over, where certain regulators might have chosen not to regulate cryptocurrencies, but now no longer have a choice. So I think all in all, that's a very good step towards the industry overall. And 2 other things I think that are tricky. I mean, I'll leave the audience to decide whether it's good or bad. So the first one definitely is better, like more towards good, that regulatory ambiguity is disappearing. So 2 or 3 years ago in most jurisdictions, you wouldn't know what to do with a cryptocurrency exchange. You wouldn't know what regulations you're supposed to be following. And you transpose the ones that apply to financial institutions or even businesses in general to cryptocurrency companies. I think now most geographies have very clear definitions. Since the mention of DeFi, I think most regulators now over the next year or the next 2 years will give some regulatory guidelines to DeFi as well. So the ones that don't have the right AML processes in place, don't want to proceed in a safe and regulated manner, can no longer jump around different countries, because most countries now are members of the FATF and would need to follow these guidelines. The last one that's quite tricky is that I think Katherine mentioned this earlier, the balance of privacy versus regulations. So I think with all these guidelines, all the updates all across the world, I do think that it's tipping a little more towards regulation versus privacy. So I mean, a lot of it is unintentional as well, because I think in the draft guidance, the FATF talked about P2P transactions and how they could potentially be risky. But what most regulators would do is that they would interpret that as guidance and then just say that P2P transactions should be considered risky. And we are seeing this not just with regulators, but that mindset is trickling down to customers as well, where they want to set specific rules for unhosted wallets, have lower transaction thresholds, more due diligence, even though there's no guidance in certain jurisdictions. Naturally, because of the FATF guidance or just the draft, the mentality is moving towards a bit of like a status where it's destroying some amount of privacy. So I think that's something a lot of regulators as well as the industry will have to figure out going forward. Because I think Katherine said that cryptocurrency was amazing. I particularly like some of the privacy aspects of it. That's what attracted me to the industry. So we probably would need to figure out a way where we can maintain a balance as we proceed.
Yeah, and staying with you, Mriganka, let's take a sort of a global focus here. And we've seen in Europe over the last week a push to set up some resource to look at additional anti-money laundering collaboration across the 27 member states. Just today in the UK, Her Majesty's Treasury issued a consultation on enhanced AML, specifically focused on the travel rule for crypto assets. So being in Singapore, as I know you are, perhaps discuss some of the approaches in other countries outside the US, together with what you're seeing in terms of the community's response and where we're at with the industry sort of developing workable solutions to implement the travel rule, and even if it has been implemented across the globe.
Yeah, I think that's an interesting question. I also think it's quite broad. The world ex-US would comprise of quite a few countries, all of them having slightly different policies. So I think broadly, you could break them down into countries like Singapore, the UK, and EU, where regulators now have a very proactive licensing policy or clear AML guidelines. And the second segment would be countries like India and certain parts of Africa, where I think now, because of the FATF's guidelines, they need to transpose this within their regulations and are struggling. So in the former segment, in Singapore and the UK, we're seeing a lot of innovation. So like you mentioned today, the HMT published a consultation paper. Most of that consultation paper was just questions. I think they've suggested that virtual assets will now be part of like the ML, money laundering and terrorist financing regulations. And a large amount of that consultation was just questions towards the industry. What are they thinking about the travel rule? How feasible is it? How expensive it is? And in Singapore actually was an early adopter of this. So with what we noticed was that a lot of companies in Singapore started experimenting with the travel rule because the regulator had been quite proactive. Very early on, they'd given a guidance that all of FATF's regulations would have to be followed by crypto companies that get licensed in Singapore. Not just that, the common word that they use is FATF++, where they do everything FATF has asked for as part of their regulations, but implement more threshold requirements, more reporting requirements. Even in terms of the travel rule, I believe Singapore has a threshold where above 1,500 Singapore dollars, you need to publish a much larger amount of private information, such as date of birth, ID number, address, which goes beyond the basic travel rule requirements as well. In terms of the industry movement, I think even regulators have been flexible. They've kept an open mind. Most companies have to have a game plan or a roadmap in place as to how they will evolve with the travel rule. They do agree that it can be done in phases. They don't require 100% or perfection from day one. So I think that's something quite unique, where regulators now are adopting a product mindset or a lean mindset, where they publish guidances, publish guidelines, give the industry time to respond, and then go ahead and evolve as the industry progresses as well. So that's been quite refreshing overall with regulations in some sections, such as Singapore. And I guess in a lot of Europe, what we've been seeing is that most European countries have said that money transfer regulations already existed, And there's no reason crypto companies shouldn't have to abide by money transfer regulations, which effectively enforces the travel rule. So now they would just give clarifications that this also applies to cryptocurrency companies. But again, I think the danger we are seeing is that they do look at the FATF guidance, implement everything there, but go a step further and add in far more restrictions. So shorter term, it's bad for companies, smaller companies that are growing, but longer term, it's definitely good for the industry because that means that there's going to be a lot more institutional adoption. In terms of actual implementation, we are seeing some closed networks where 5 to 10 VASPs get together and implement the travel rule. And they've been using multiple protocols. There are multiple providers out there. I think interoperability is one key factor. Everybody is trying to make sure there's a lot of interoperability. At this point, unfortunately, what we've seen is that because of the fact that not everybody abides by the travel rule, even though we integrate with multiple vendors, at some point of the value chain, the entire process of transfer of information or exchange of information isn't getting completed. So that will probably have to evolve as more and more companies start adopting it. The actual execution of the travel rule within VASPs will get better, according to us.
Thank you so much. And before we move on to the fourth question, which is focused on stablecoins, there's been some interesting questions from the audience. So thank you so much. I think I'll pick up the one on from an anonymous attendee. There is no such thing as cryptocurrency regulation. This is interesting because we've been talking about regulation for the last half an hour. So to read the question out for those that can't see it, there is no such thing as cryptocurrency regulation. That is a confusing conflation of subject matters. Regulation limits the behavior of citizens. Cryptocurrencies are regulated by code or software. Unless you understand the difference, you should not attempt to talk about this. So that's that's a contentious question. I'll sort of set the scene and open up to the panel because I can see that everyone is desperate to give their view. Now, I've worked closely with policymakers for the last few years in the crypto space, and what I've learned is regulators aren't there to do anything other than protect against risks of harm to consumers because people get scammed, people are vulnerable, and also economic crime. I don't think there would be, well, I can't speak for everybody. I would hope that everyone attending today realizes the economic harms that terrorist financing and money laundering brings to our communities. So that's my 2 pennies worth. So let me throw it out there. Has anybody got any burning responses to this question?
I do.
Go for it.
So, well, saying that there's no cryptocurrency regulation is like saying there's no monetary regulation or no stock market regulation. It's just not true. I mean, it's a matter of semantics. I do understand the point, I believe, of our anonymous attendee's question. The situation does get nuanced, particularly in DeFi. And this is a challenge we're all going to face here, which is you can certainly provide regulations that this is a money service provider. We believe Bitcoin or Ethereum or Tron or whatever it is an asset or a currency or both, and has a whole set of regulations that have been developed for the last 80, 90, 100 years. And they fall underneath that. When we get to DeFi, it becomes more interesting because you can say, well, what if 5 anonymous people write some software and software controls everything? There's no company, who benefits? This is where we're starting to tread into the dangerous waters of regulating the development of software, which then leads me to recall to the crypto wars of 1995 and beyond, which was writing cryptography software and exporting it outside of the country, at least in the United States, was illegal because it fell under regulatory controls of ITAR and it was considered an arms. Now, that was eventually overthrown because it was shown that everyone just imported their crypto like SSL from Australia. And so the whole thing was moot because, what's the point? And it just moves offshore. But I think this is dangerous waters that we're moving in right now, which is, are we going to try to regulate the creation of software which controls dApps, which controls DeFi. This is a very, very touchy area. And I think that's the actual point of hopefully maybe a response to this question, which is very well put, I think. But regulating software is different from regulating companies and the movement of money.
Yes, and we could argue all day long as to the additional guidance that FATF gave as to whether they initially said we're not going to regulate software, but actually now we are. We see a decentralized operation if run by a community. If there's the objective of receiving gains, then the community could be liable. Now, it's an interesting philosophical debate, and you touched on the crypto wars, and yeah, that just seems nonsensical now that you can't have public-private key outside of one jurisdiction. We've had these discussions with the internet as well, and hopefully with industry engagement, and that's why trade bodies exist. And you may be aware that Uniswap just released the community a grant of 20 million, depending on the price of uni, to do exactly this, to educate. It's called the DeFi Education Fund. They're building out that foundation right now, but with the sole purpose to go out there and ensure that the regulation that they believe is coming, because they wouldn't have done this if it hadn't, that is fair and balanced and proportionate, that doesn't destroy code. Because we at CryptoUK work with a whole bunch of other trade bodies across the globe to write a letter to FATF specifically highlighting the societal benefits of DeFi and other such decentralized autonomous organizations. So yeah, let's move the discussion on to our last topic, stable coins. So I'm going to pose this to Mandeep, naturally, who's at Circle. So as most jurisdictions' interest was piqued when Facebook announced its project, today called Diem, we have seen the major jurisdictions across the globe issue consultations and guidance and senior members of government talking about bringing stable coins into the regulated perimeter. Naturally, working at Circle, you'll be intimately familiar with the Stable Act in the US. And recent research from a board member of the Federal Reserve and a professor from Yale University. Can you give us your view as to the appropriateness of this government approach in regards to how stable issuers should be regulated? And if stablecoins, as suggested in the paper and the Stable Act, bring systemic risk to payment infrastructure and the economy in the way that shadow non-core banking did 100 or so years ago?
Yeah, thanks, Ian. I think it's an important question of the day. Like someone said previously, we are constantly hearing and reading developments coming out from the government and a regulatory community on this. So it's definitely important. Look, having worked at DM previously and now at Circle, I actually think the substantive risk topics that everybody's discussing are definitely important and should be evaluated for us to get right. Whether it's from a systemic risk perspective, whether it's from a anti-financial crime perspective, whether it's from a consumer protection perspective, we've got to understand these risk topics stablecoin by stablecoin and make sure that the right controls are in place, the right protections are in place before stablecoins actually become mainstream adopted and all parties are comfortable with how they're playing a part in our financial systems. I actually overall see these developments as a positive step that are required for this segment of the industry to be adopted mainstream in the financial system. I'll say four main points from a tangible perspective, right? One is we need to recognize the role of the private sector and the role that technology innovation plays and has played historically in coming up with new payment systems and new innovations. How does money actually need to move in a fast manner? How do we reduce cost? Today, technology is absolutely an important part of that. And the reality is, no matter how you cut it, blockchain infrastructure, open internet-based systems are a reality as well. If you look at the growth that's happening exponentially, that is not going to stop. It is going to continue. So the challenge really becomes, how do we think about the right regulatory requirements and these right technology innovations that are taking place, exponential growth that is taking place, and marry these two and come up with a model that actually protects our customers, protects our citizens, but also at the same time reaps the benefits of blockchain technologies and open internet-based systems. So I think that's the first macro point is that it cannot be a governmental focused solution only, or a private industries solution focused only. It needs to be a combination of the two. There needs to be a balance between these technology like innovations and speed of money movement with the importance of controls and safeguards, again, from all the respective topics of consumer protection, financial stability. As an industry, we have an opportunity to actually present to regulators and the government, and we spoke about it previously, regarding how do we answer the questions about who is on the other side of the transaction. Is there a benefit for us to think about technological solutions from a digital identity perspective, decentralized identity perspective? Is there a way we can actually use open internet systems, blockchain systems to actually run decentralized identity without leaking private information all over the place? Move away from central ID verification to decentralized ID verification. So there are lots of questions there that I believe lie at the root of what FATF is trying to get at, what regulators are trying to get at, and the industry has an opportunity and a challenge to actually come up with technical solutions to address those endpoints. The other thing I'll say, as I said previously, is not all stable coins are created equal. It has to be an evaluation that happens stable coin by stable coin. What is the overall approach? What are the different regulatory parameters that apply to that particular stable coin? What is the overall financial stability impact of that particular stable coin? So I think all those factors have to go in before a overall framework is created regarding how exactly implementations need to be done. So that's my overall view on this space. And then specifically for Circle, our core central belief is that we cannot move away from regulatory compliance. Regulatory compliance and risk management is absolutely central to our entire business strategy, our entire strategy, creating the payments infrastructure, thinking about USDC. We are regulated today as a money transmitter in the US. We are regulated as an e-money issuer. We are firm believers in engaging with regulators around the world and thinking through what the right frameworks should be for the future. And we are monitoring those as and when those frameworks evolve, regardless of the direction they take. Our plan is to comply with those requirements, because end of the day, we do not believe that we can exist and succeed overall in terms of our end game, our end goal, without the regulatory community and the governmental community sort of working with us and us working with them. So net, I would say Circle is focused on creating that culture within our company where compliance is not a constraint. It's part of the reality of success for us. And that's what we're focused on.
Yeah, it's interesting. I'll pick up on all stable coins aren't created equal. And we can talk about all market participants, not just in crypto, in any industry. And I'll draw a comparison to some trading exchanges in crypto. Some are really regulatory compliant, and then others perhaps not so. But what we're seeing today is those that didn't have that strategy initially being pulled, if you like, kicking and screaming into the regulatory perimeter. And in terms of Circle, I know that USDC voluntary does an audit and does proof of reserves. We know Tether and the action against them from the New York attorney, and part of that settlement was to produce a report. Now, whether you think the report makes any sense in terms of the amount of liquid assets that they're holding as reserves, that's a whole nother discussion. But we've already seen this regulation coming. It's been being forced. It's reactive, non-progressive issuers or operators getting pulled into the regulatory perimeter. So we used to say when we first started working in the crypto regulatory space some years ago, if you don't want to be regulated, then go to the moon, because the government can switch off the power. And I know that goes against some of the the movement, especially the cypherpunk movement, and the belief that central entities are bad and do awful things. And yes, there is that debate, but what narrative does the industry want? Do we want mass adoption, or we're going to have to be regulated? If we want it to stay underground, then fine. So let's move to some additional questions. Let's see. I did prepare a couple earlier for the panel. So let's go back to FinCEN. And I know Michelle touched on some of the collaborative work they're doing. What do you guys think regarding FinCEN's firstly collaboration with other US agencies and overseas entities? Do you believe it's happening? Should it happen? What's the thoughts of the panel?
Well, my experience is that FinCEN cooperates very well with agencies all around the world. I see them at BATF meetings. I see them at Europol meetings. I see them at Interpol meetings. They're involved IMF and other things. I mean, I think their engagement is fantastic. They put a great investment into it. They put people into it. I've been very impressed with their work. And also, it's not just telling people how they think, it's listening.
That's good to know. Thank you.
I would also add, FinCEN, also kind of works with other financial intelligence units across the globe. I think, they know that they kind of, in this cryptocurrency space, as Michelle kind of alluded to, they were, one of their first movers in terms of defining and explaining, what was going on. And so I think they have seen, their definitions kind of carry not only in the US, but also kind of across the world. And, as Dave said, that they understand that, they also have to be part of these conversations because they understand the implications that it can carry across globally.
Okay, well, I'm going to sort of come to the crystal ball time here for the panel. So I'm going to ask each panelist to give their view of a time horizon in the future. And naturally, we won't hold anyone to this. It's pretty hard to forecast the future. If we could, we'd all be rich. So I noted this week, Vitalik at the Ethereum events in Paris was speaking to the community on decentralized projects outside of decentralized finance, possibly a rallying cry to move the needle on the industry coming together ahead of policymakers regulating decentralized apps, and perhaps to support against the economic crimes you mentioned earlier. What does the panel think? And I'll go to you first, Katherine. Where do you see the industry specifically around the regulatory perimeter in a time horizon of, say, 2 to 5 years, a medium-term time horizon?
I kind of see the industry coming to understand that you can't really avoid regulations. You could try to avoid, but then the alternative is, complete shutdown in, certain countries that we've seen of cryptocurrency. And, that's not exactly a space I think the industry wants to be either. And so what I see, in the next 2 to 5 years, as Michelle was alluding to at the end of her discussion, was really kind of leveraging technology, software to help them, in my favorite theme, which is efficiency. I love efficiency, everything efficient. That, they can leverage these tools and technology, such as what we're developing at TRM Labs, to help them comply and to, really, not only comply, but also, understand kind of, what is my exposure in this crypto asset, or, what is, how am I doing in this space? And, I draw a lot of parallels between traditional finance, kind of where I came from. I'm a CPA. So, what we see in accounting, when they come out with different definitions and regulations, I see a lot of parallels with, what we see in traditional finance. We talk about the 2010 flash crash, which was caused by, code, that you can draw a lot of parallels between, what has happened historically, with the mortgage crisis. I was there post-mortgage crisis looking at mortgage loans. loans that, could come about, under the DeFi space, that, you kind of see these exposure areas that could be coming and kind of the regulations that could be coming with it. And so I think, as we're kind of talking about the next 2 to 5 years, that you're kind of drawing parallels between what has happened in our history. I always say learn from our history. It's history for a reason. So that we can, better interpret, we can better, have tools, better, have better, I guess, knowledge about the approach so that, we're not kind of taken aback.
Thank you for those insights, Katherine. Let's ask the same question to Mandeep.
Yeah, I think from my standpoint, I get excited about the next 2 to 5 years, thinking about what DeFi can actually achieve for people in the world, how DAOs can actually change how we actually operate our financial systems and non-financial systems, how we can get more efficient, we can be cost efficient as well. I think that's what I get really excited about. And then on the flip side, I think to Katherine's point and what I was saying previously as well, regulation and compliance is a reality to achieving that world. And so I'm excited about what new technological innovations we can actually do from a regulatory and control perspective as well. So that's the way I see it. If we can get this balance right, I think there's a world in 5 years where we would have solved a lot of problems, societal problems in the world, and that's what I'm focused on.
Thank you, Mandeep. And Mriganka, what's your view on what the future holds?
So yeah, my view is similar to, I think, both Mandeep and Katherine. In 5 years from now, especially if you're starting a centralized crypto company, I think everywhere, at least, like there would definitely be regulations and AML/CFT you would have to abide by. I think if you want to avoid that, Mars might be your best bet if we get there by then. But apart from that, like the other aspect is also quite exciting. So DeFi will probably split up into 2 segments. So there would be sections of DeFi that are heavily regulated, or rather the owners of the DeFi protocol choose to go through a regulation heavy approach. So something like a hybrid DeFi version where there's some layers of KYC, AML, blockchain monitoring. And of course, I think there would also be the other side of it, just like mixers operate right now, or just like there's the darknet. There would definitely be a segment of DeFi that goes the other route completely, like the spirit of 100% innovation and full privacy. It would be very interesting to see how enforcement of that happens, because I think we were discussing before the panel as well, how would you go about enforcing something like a sushi? So to a certain extent, of course, there would still be people involved at some place. So just like law enforcement agencies use our help to take down mixers, they might end up targeting these DeFi protocols. But yeah, that would be another dimension of innovation, which I'm like quite interested to see the evolution of as well.
Mm-hmm. Thank you, Mriganka. Yeah, and let's see the same question to Dave, please.
Thank you, Ian. I think about it in a few different vectors. I think that you're going to see a lot of the regulations we have today applied to crypto. So for example, you will see market regulations applied to exchanges. So looking at front running, price manipulation. That is obviously, one of the sponsors of this wonderful conference are a team that are building that technology right now. Second thing I see, obviously banks are moving into this space. They are having to do it because their customers are demanding it, whether it's custody services, onboarding, buying, selling crypto. We're also seeing at Ciphertrace banks asking us about how they get safely into DeFi and offer those products to their customers. I've been saying for several years, I think maybe it's not the 5-year time frame, but 10 years, every country will have a CBDC of some form. I'd say to the point that was made just prior to this, there's the whole conversation about DeFi versus CeFi, which is really a lot of DeFi products really are centralized. They just put DeFi as the name, and yes, they have a They have a contract, so certainly regulation. I'll say that I think if we think about the next 5 years, DeFi is hugely challenging for the regulatory side of things. It implies things like digital identity on unhosted wallets. It implies many things. At Ciphertrace, we released, I think, the world's first DeFi oracle for anti-money laundering controls a couple of months ago and sanctions controls. But there's so much more to do here. I would suggest, and I'll just put a different spin on things. I think it's a little bit of an uncertain outcome on the regulatory side of what happens in the next 4 to 5 years here, because DeFi is moving so quickly. Many people want no regulation and no regulatory controls. They're working hard to do that. The old cypherpunk, values are surfacing up in the new generation. And these are the people that are being able to manipulate, or rather, sorry, not manipulate, but mobilize many teams of talented developers coming out of financial services into this world. It's not certain to me that the regulatory infrastructure is completely incapable of handling it in 5 years. I think that may be true. It's a possible outcome here that in 5 years from now, the regulatory space looks extremely different and large parts of it are not able to be controlled. So we'll give you that to think about.
Well, thank you. Thank you for those closing remarks. It would be unfair of me to ask you guys for your views of the future without me giving my thoughts. And just for the audience, whether you're aware or not, one of the major dApps are they have an institutional product that has KYC. It needs to, because the institutions are regulated, and it's the only way that you can bring institution involvement. And we're hearing on the ground with players in the DeFi space that institutions are interested and want to get involved, but you'd have, as heavily regulated organizations, they need to at least do that one lift, which is to have some customer due diligence. And then you have the whole discussion, and we didn't get into it today, and I'll just finish on sort of the DAOs, is to what level of decentralization works. Well, there's no perfect decentralization, because no protocol can be born decentral from day one. There has to be stages, product building, centralized developers. Naturally, I think Mriganka touched on the sushi swap, and enforcement is an issue there, because the developer Chef Numu is, pseudo-anonymous. The code was forked. They didn't receive any VC money, so there's no central country or jurisdiction that we know they exist in. But most have a level of centralization, in my experience. And then we see the recent developments of some DAOs and some communities making themselves look like a centralized entity. For example, Uniswap V3 putting the 2-year block on open sourcing their code to obviously address what happened previously with the sushi swap. And then Curve Finance recently discussed in their community whether they should put some protections legally around their protecting their IP. And then if they do that, they make themselves again look centralized. And we know in the UK, the Law Commission have done some groundbreaking work around the legalities of smart contracts. And for example, what would happen in the effect of the DAO hack? Where's the recourse? Could you go and find the folks in Australia that were promoting this initially, set up a website? And we've seen other examples as well in the US and other jurisdictions. So there's a lot for the industry to think about. So I'd like to thank my panelists for their wonderful insights today. As it's the last panel of this wonderful 4-day event, I'd like to thank the sponsors and all the folk that have worked tirelessly to put this wonderful event together and create some terrific content for the community. With that, I'll hand it back to Alyssa.
Thank you so much to Ian and to our panelists for a truly insightful session. Another big thank you to all of our attendees for tuning in, especially those that have bared with us for all 4 days. If you do want to rewatch any of today's sessions, we'll be sending out the videos in the coming days. And on behalf of CryptoCompare, Securrency, Solidus Labs, and Global DCA, thank you so much for joining us at DACOM DeFi.